Most people know Ray Dalio as the man who built the world's largest hedge fund, the man with the big cycle framework and the all weather portfolio and the $150 billion under management. Nobody talks about the payphone. 1982, Manhattan. Dalio is 33 years old and everything is gone, and he has to make the hardest phone call of his life today. In his own words, Ray Dalio tells you what happened at that payphone, what he said, what came back to him in the silence, and the single discovery he made in the wreckage of his greatest failure that became the foundation of absolutely everything he built afterward. Let's go.
I want to tell you about the worst day of my professional life. Not because I enjoy talking about it, because I think it is the most useful thing I can share with you. And I have spent enough time around people who only talk about their successes to know that the failures are where the real education lives. Anyone can teach you what worked. The harder and more valuable thing is to show you what broke and what you find in the breaking. It was 1982. I was 33 years old. I had spent the previous 7 years building Bridgewater Associates from nothing. Started it in my two-bedroom apartment on Park Avenue in Manhattan with no clients and no capital and nothing but a telephone and what I believed was a genuine understanding of how economies work. By 1982, we had clients. We had a small but real team. We had a reputation that was beginning to mean something in institutional finance circles, and I had a thesis. The thesis was that America was heading into a depression, not a recession, a depression. I had been studying the debt dynamics, the leverage in the banking system, the vulnerability of the global financial system to a sovereign debt crisis building in the developing world, and my analysis told me with complete and absolute certainty that a catastrophic economic contraction was coming. I did not share this privately. I could have. I went on television and said it. I testified before Congress about it. I wrote about it. I told every client I had. I told everyone who would listen. And then I backed the thesis with real money. I structured Bridgewater's positions around the conviction that everything I was predicting was not just likely, it was inevitable. And then Paul Volcker cut interest rates. And the market, with complete indifference to my analysis and my certainty and my congressional testimony and my television appearances, went in the other direction. Not slightly, dramatically. The Dow exploded upward. Every position I had built around my thesis went against me. Every client who had trusted my analysis suffered for it. The phone calls started coming in, and they were not the kind of phone calls you want to receive when you have spent 7 years telling people you understand markets better than they do. I lost the clients. I lost the staff. I had to let everyone go. Bridgewater went from being a small but growing firm with a future to being me alone in a space that suddenly felt enormous in the wrong way. I had to borrow $4,000 from my father to cover the family's basic expenses. My father was a jazz musician. He did not have a lot of money to lend. The fact that I needed to ask him for it was its own kind of humiliation on top of the professional one. But the moment I remember most clearly from that entire period is not the day the thesis failed. It is not the client calls. It is not the staff departures. It is the payphone. I was walking through Midtown Manhattan late in the afternoon after a day that had gone exactly as badly as you would expect a day to go, when everything you publicly committed to has just been publicly wrong. I did not want to go home yet, because going home meant having a conversation I did not know how to start. I stopped at a payphone on a street corner, one of those old New York payphones with the metal cord and the smell of 1,000 previous calls. I stood there for probably 5 minutes before I dialed. Barbara answered, my wife, the person who had watched me build this from nothing, who had listened to the thesis, who had heard the certainty in my voice when I explained why I was right, who had trusted not just my analysis, but my confidence in my analysis. I told her the simplest version of the truth I could find. I told her it was gone, that I had been wrong, that the thing I had been so completely certain about had turned out to be the opposite of what happened, and that the consequences were exactly as serious as you would expect. She did not say what I expected her to say. She did not tell me it was going to be okay. She did not offer immediate reassurance. She was quiet for a moment, and then she said something that I have never fully repeated publicly because it belongs to the two of us. But what she communicated in that silence before she spoke and in what she said after it was something I needed more than any financial recovery at that particular moment. She still saw me as the person she married, not the thesis, not the performance, me. I hung up the phone and stood on that sidewalk for a long time. And in that stillness, in the specific kind of quiet that arrives after humiliation has finished doing its work and before the rebuilding has started, I began to ask myself the question that I had been too proud and too certain to ask before. How could I be that wrong? I want to be precise about why that question matters. Because the obvious answer, the answer most people in that situation settle for, is circumstantial, bad timing, unexpected policy decision, the specific sequence of events that produced the outcome I had not predicted. I refused to accept that answer, not out of masochism, because I knew that if I accepted it, if I explained the failure as a product of circumstances rather than a product of something in my own thinking, I would carry that same flaw forward into every subsequent thesis. I would be just as wrong again, for the same hidden reason, with different surface details. So I sat with the harder question, the question that required me to look at myself the way I looked at a market, without sentiment, without protection, with radical honesty about what I actually found. And here is what I found. I had not been sharing an analysis. I had been pronouncing a verdict. There is a difference that I had not understood until that moment. An analysis holds its conclusions loosely. It says, here is what the evidence suggests, and here is how confident I am, and here is what would make me change my mind. A verdict closes the door on alternative interpretations. It says, I have decided. The decision is final. New evidence will be accommodated if possible and dismissed if not. I had been issuing verdicts for months in front of clients, in front of Congress, on television. And with each public statement, the verdict had become more rigid, more defended, more resistant to the quiet signals that were contradicting it. Because changing my mind publicly would have required admitting that the previous public statement was wrong. And the ego cost of that admission kept growing with every new statement I made. This is what I eventually came to call the enemy of good thinking. Not stupidity, not laziness, not insufficient data, pride. The specific form of pride that dresses itself up as confidence and conviction and expertise and makes itself almost impossible to see from the inside until it has already cost you everything it is going to cost you. I built a principle from that specific discovery that has governed everything Bridgewater has done since. I came to call it radical open-mindedness. And I want to explain what I actually mean by it, because most people hear the phrase and think it sounds like a personality type, something you either have or do not have, a temperament rather than a practice. It is a practice, a deliberate, sometimes violent practice of making yourself confront the possibility that your most confident beliefs are wrong. Not occasionally, systematically. Every time you find yourself feeling that specific certainty that I felt in 1982, the certainty that the conclusion is so clear that questioning it is almost insulting to the intelligence of the person being asked to question it. That feeling is the signal. That feeling is the moment to stop and ask harder questions rather than issue another verdict. After 1982, I built systems to make that questioning unavoidable. not because I trusted myself to do it voluntarily, because I knew from direct and expensive experience that I would not do it voluntarily when the emotional stakes were high enough. The ego is too good at finding reasons to protect its existing positions, too creative at constructing narratives that accommodate new evidence without actually updating the conclusion. The systems I built were simple in concept and brutal in practice. Any person at any level inside Bridgewater could challenge any idea from any other person, regardless of seniority. Every important decision was debated openly with the explicit goal of finding the best argument rather than validating the existing one. I hired people specifically because they disagreed with me, not people who politely raised alternative perspectives, but people who fundamentally believed I was wrong about important things and could tell me why in specific and rigorous terms. I called this the idea meritocracy, and the idea behind it is straightforward. The best ideas win regardless of who they come from. Not the most confident ideas, not the ideas from the most senior person in the room, the best ones tested against the best counter arguments available. This approach did not make Bridgewater popular in the early years. It made it uncomfortable. It made it the kind of place that certain types of very talented people thrived in and certain other types of very talented people could not tolerate. People who were attached to being right found it unbearable. People who were more interested in finding out what was actually true found it exhilarating. The distinction between those two motivations, between wanting to be right and wanting to find out what is true, is the most important professional distinction I have ever observed. And I believe it is the most reliable predictor of long term success in investing, in business, in any domain where reality has the final vote. And reality does not care about your ego. I also built something else from the 1982 experience, something more specifically financial. And this is the thing that I want every person watching this to understand, regardless of whether they run a hedge fund or manage their own retirement account. I asked myself a question that I had never asked before. And the question was so simple that I am almost embarrassed to say it took losing everything to make me ask it. The question was, what kind of portfolio would survive if I was wrong about everything? Not a portfolio designed to perform well when my current thesis is correct. I had built that portfolio. I had built it brilliantly, and it had failed spectacularly when the thesis failed. A portfolio designed to survive when I was wrong, when the scenario I considered most likely turned out to be completely backward, when the certainty I was most attached to turned out to be the most expensive assumption I had ever made. I thought about the range of environments an economy can move through: growth stronger than expected, growth weaker than expected, inflation higher than expected, inflation lower than expected. Four basic scenarios. And in each scenario, a specific set of assets that tends to perform well. Stocks when growth is strong, long-term bonds when growth is weak and inflation is falling, gold and commodities when inflation surprises to the upside. Different combinations and different weightings for the spaces in between. The insight was not that any one of these scenarios was more likely than the others. The insight was that I did not know which one was coming, that nobody knew, that the confidence with which forecasters, including me, presented their predictions was systematically overstated relative to the actual predictability of economic outcomes. And if nobody truly knows which scenario is coming, then the rational approach is not to build a portfolio for the scenario you believe in most strongly. It is to build a portfolio that is genuinely balanced across all of them, so that whichever one arrives, you survive it. Not perfectly, not without cost, but intact, able to compound from wherever you land, rather than starting over from zero. I called this the all weather approach. because the goal was a portfolio that worked in all economic weather, not the best possible portfolio for sunshine, a portfolio that could handle rain without drowning. This idea, which eventually became one of the most widely imitated investment frameworks in the world, was born directly from standing at a payphone and understanding in my bones what it felt like to have built something beautiful and fragile and watch it shatter completely because I had not asked the right question. The right question is never, how do I win when I am right? The right question is, how do I survive when I am wrong? Because you will be wrong. I was wrong in 1982 with more conviction and more public commitment than I have brought to almost any subsequent position. The people who told me I was wrong turned out to be right in ways I could not have accommodated within the model I had built. And what I discovered is that being wrong does not have to be the end. It can be the beginning of something more honest and more durable than anything you could have built from certainty alone. The most important thing I want you to know is how to deal with what you don't know. That sentence did not come easily to me. It came from a payphone, from a $4,000 loan from my father, from a wife who loved me enough to be quiet for a moment before she spoke. It came from the wreckage of the most public and most complete failure of my professional life. And it is the most valuable thing I have ever learned, not because it made me feel better about 1982. It did not. I still think about that year with a specific kind of discomfort that has never fully gone away, and that I do not want to go away because I need it there as a reminder. But because it changed the question I asked about every subsequent decision. Not, am I right about this? How bad is it if I am wrong? And have I built something that survives the answer to that question? I have now managed money for over 50 years through crashes and booms and currency crises and debt cycles and geopolitical upheavals that nobody predicted, and several that everybody predicted and turned out not to happen. And the thread that runs through all of it, the single thing that I believe has made the difference between Bridgewater surviving everything and being destroyed by something, is that payphone call, not the call itself. What I decided in the silence afterward, that I was more interested in what was actually true than in being right about what I had already said. That distinction, small as it sounds when stated plainly, is the widest gap in investing. And almost everybody ends up on one side of it or the other, usually not by choice, usually because something happened that made the choice for them. I am hoping this video makes the choice for you before something else does.
A payphone, $4,000 borrowed from his father, a wife who stayed quiet just long enough to let him hear himself, and from that, $150 billion, the world's largest hedge fund, one of the most important investment frameworks ever built. The distance between the failure and everything that came after it was not intelligence. It was one question asked with brutal honesty in the worst possible moment: how do I survive when I am wrong? Your action this week. Look at your most confident position, the one you have been most certain about, and ask yourself honestly, what happens to me if this is my 1982? Not to scare yourself out of it, to find out if the answer is something you can live with. What is one investment lesson you have learned? Share it in the comments below. And as always, I will see you in the next video.